Okay, here we're going to be looking at a determination and distribution of excess schedule that's used for consolidating a subsidiary company with its parent company. The schedule here compares the subsidiary's fair value with the recorded book value of the equity of the subsidiary, and it shows the amount of adjustments that will be made to the subsidiary accounts here in the consolidation process. For example, here we're going to be looking at a 100% acquisition where Corporation A, the parent corporation here, buys Corporation B, the subsidiary. So looking at our distribution schedule here, we have to determine the fair value of the subsidiary, and then we also have to determine the book value here of the interest acquired, and that's based on the total shareholders' equity that Corporation B in this case has on its books. So we look at the value of its stock here, additional paid-in capital, and also the retained earnings here. And then we total this total shareholders' equity of Corporation B here and compare it to its fair value here. And then we have to determine an excess of the fair value over the book value here. And now, knowing these amounts here in this distribution schedule here and the balance sheet amounts here of a Corporation B, we can determine the adjustments that are needed here to eliminate the subsidiary's accounts when making the consolidated balance sheet for the parent and the subsidiary company. Okay, let's look at the balance sheet here for Corporation B. We know its book value or its carrying value here for the assets, the liabilities, and shareholders' equity. But what we have to do is determine the fair value here of these assets and liabilities at the time of the acquisition here of Corporation B by Corporation A. And the difference between the book value here and the fair value are the adjustments that have to be made for this consolidation process of Corporation A and Corporation B's balance sheet. So looking at our value analysis here, in this case Corporation A purchased the net assets or their fair value here of Corporation B, and they exchanged common stock or their common stock for these net assets. So in this case, Corporation gave Corporation B, in this case, $860,000 worth of their common stock. And to determine the fair value of our net assets, what we do is we take the fair value of our total assets here of $920,000 and then subtract the difference here with the fair value of the total liabilities of $160,000, and then the difference here would be $760,000. Now that's the fair value of the net assets here that Corporation A is acquiring from Corporation B. And then to determine if there's any goodwill in this acquisition here, we take the price paid. In this case, it was $860,000 worth of common stock issued by Corporation A to Corporation B, and then we compare it with the fair value of the net assets that we acquired here of Corporation B, in this case $760,000 worth, and you can see that the difference here is $100,000 worth of goodwill that was involved because the price paid here was greater than the fair value of the net assets received. Okay, so now looking at our distribution schedule, the fair value of the subsidiary was $860,000 here. That was the common stock that Corporation A issued to Corporation B in acquiring Corporation B, and then we take the less the book value of Corporation B's here total shareholders equity shown up here on their balance sheet. So comparing the total shareholders equity to the fair value of the subsidiary here of $860,000, we got an excess of the fair value over the book value here of $525,000. Now that's the amount that has to be accounted for here when we make our adjustments to our accounts here in the consolidation process. The $525,000 here has to match the our adjustment account here of $525,000 has to equal this excess of the fair value over the book value. So looking at our adjustment accounts here, all I did is taken the book value here and compared it with the fair value for Corporation B's assets and liabilities. And then when I'm getting down here, just to note this here, for the liability accounts, I show them as a negative figure here, but they actually are increasing when we do our consolidation process here for our liabilities. But I show them as a negative amount here because they subtract the other side of the equation, or they subtract from the asset accounts here when determining our total value of our adjustments. And I also have the goodwill here included here in that in this acquisition process, and it was $100,000 in this case. So these adjustments to the subsidiary accounts in our consolidation process here is adjusting the subsidiary or corporation B's from their book value to their fair value here. Now in this case, the total adjustment has to be made in the subsidiary accounts based on, in this case, 100% acquisition. Okay, the journal entries here for consolidating Corporation B, the subsidiary, with Corporation A, the parent. We'd first adjust Corporation B's accounts to their fair value, and that would be based on the difference between their book value and the fair value here shown in this accounts adjustments list. Then we'd combine here the asset and liability accounts of Corporation B and Corporation A. Now, Corporation B's accounts here after their adjustments would be their fair value here as shown on the balance sheet. And that's the amount here that we would be combining with Corporation A. Okay, finally in the consolidation process, we have to eliminate here the Corporation A's investment account here in Corporation B and Corporation B's equity account. So first looking at Corporation A's investment account, we would have debited that for $860,000. That was the stock that was issued to Corporation B for their assets and liabilities, and then we'd reduce that in two amounts here. First look at for $525,000, and that would come off our distribution schedule here, and that would be the excess of the fair value over the book value for this subsidiary here, and that was $525,000. And that $525,000 would have these balancing amounts here for the adjustments to the asset and liabilities, and it would also include the goodwill here of $100,000. So the total amount here for our assets, our liabilities that we acquired, plus the goodwill here was of $100,000, was a total here of $525,000. So these increases or adjustments to these accounts here would balance here with the investment account, or reduction here in our investment account here of $525,000 for our for Corporation A here. And then the next amount here was the $335,000 that would reduce this investment account. And again, we can go up here to our distribution schedule, and that was the equity amount here, or the book value of the equity amount here acquired from Corporation B. And the $335,000 here balances with the fact that we have to eliminate here Corporation B's equity account for the stock value here plus the retained earnings amount. So the subsidiary account here had a book value of $335,000 for the equity and the retained earnings account here for total shareholders equity of $335,000, and then that would be reduced here by $335,000 or closed out because it no longer exists since Corporation A has acquired Corporation B. So looking back at our accounts here, we have a zero balance here in our investment account for Corporation A, and then the subsidiary account here for Corporation B here, its equity accounts and its retained earnings were also zeroed out, or would have a zero balance. Okay, in summary for this consolidation process, we first combined Corporation B's asset and liability accounts at their fair value with Corporation A, the parent company, and then we eliminated the investment account here that Corporation A had in Corporation B, and also had to eliminate the subsidiary account here of Corporation B's shareholders' equity accounts. That was their common stock here accounts and their retained earnings here accounts carried at the book value on their balance sheet.